Bila-bila masa, di mana jua?
The purpose of this study is to analyze and compare the financial performance of Apollo Food Holdings Berhad and Seng Industry Berhad over a 5 year period from 2021 until 2025. Both companies are well-known food manufacturers in Malaysia, but they have a different product lines and business strategy. To evaluate their financial performance, we use financial ratio analysis and trend analysis. The ratio are divided into 4 categories, which is liquidity ratio, activity ratio, profitability ratio, and leverage ratio. Through this analysis, we can identify which company performance better in terms of financial stability, operational efficiency, and profitability, and long-term sustainability. Now, I will briefly introduce both companies. The first company is Apollo Food Holding Berhad. Apollo was established in 1953 and has been listed on the main market of Bursa Malaysia since 1994. The market manufactures and distributes chocolate confectionery, chocolate-coated wafers, layer cakes, and jelly products. Today, Apollo exports its product to many countries including Singapore, Indonesia, Thailand, China, Japan, India, and several Middle Eastern countries. The company's headquarters and manufacturing facility are located in Johor Bahru. Analysis of corporate financial performance and trend and comparative. The second company is Seng Industry Berhad. Seng was founded in 1958 and listed on Bursa Malaysia in 2000. The company is famous for cream crackers, biscuit cookies, confectionery, and instant beverage products. Its manufacturing facilities are located in Batu Pahat, Johor. Today, Seng exports its product to more than 60 countries around the world, making it one of Malaysia's leading food manufacturers. Next, I will explain the liquidity ratio. Liquidity ratio measures a company's ability to meet its short-term financial obligations. The first ratio is current ratio. Throughout the 5 years, Apollo recorded a much higher current ratio than Seng. Apollo current ratio even reached 21.85 times in 2023, indicating that the company had a very large amount of current assets compared to its current liabilities. Meanwhile, Seng maintained a stable current ratio of around 2 times, which is generally considered healthy and efficient. Next, I will explain the liquidity ratio. Liquidity ratio measures a company's ability to meet its short-term financial obligations. The first ratio is current ratio. Throughout the 5 years, Apollo recorded a much higher current ratio than Seng. Apollo current ratio even reached 21.85 times in 2023, indicating that the company had a very large amount of current assets compared to its current liabilities. Meanwhile, Seng maintained a stable current ratio of around 2 times, which is generally considered healthy and efficient. Next, I will explain the liquidity ratio. Liquidity ratio measures a company's ability to meet its short-term financial obligations. The first ratio is current ratio. Throughout the 5 years, Apollo recorded. The second ratio is quick ratio. Apollo again recorded much higher values, showing that even without inventories, the company could easily settle all its short-term liability. Seng quick ratio remained between 1.65 and 1.91, which is also considered financially strong. Next is the net working capital. Net working capital measures a company's ability to cover its short-term liability using its current assets. Based on the analysis, Apollo maintained a much higher net working capital throughout the 5 years, ranging from about RM 135 millions to 167 millions. This shows that Apollo has a strong financial buffers and good liquidity. Meanwhile, Seng also shows a positive growth, increasing its net working capital from around RM 71 million in 2021 to RM 92 millions in 2025. This indicates the Seng managed its working capital effectively while supporting its business growth. Overall, both companies had a positive net working capital, but Apollo had a stronger short-term financial position due to the higher working capital.
Hello, I'm Anastasia Limana. Here we'll be presenting our analysis of the activity ratio for Hub Seng Industri Berhad and Apollo Food Holding Berhad from 2021 to 2025. This ratio helps us evaluate how efficiently both companies manage their receivable, inventory, and asset. First is the average collection period. This ratio shows how long a company takes to collect payment from customer. In 2035, Hub Seng recorded 36.23 days compared to Apollo to 42.79 days. Since a lower number is better, this shows that Hub Seng collected payment faster and managed its receivable more efficiently. Next is the account receivable turnover ratio. This measures how many times a company collects its receivable during the year. Hub Seng recorded 9.95 times, while Apollo recorded 8.41 times in 2025. A higher ratio indicates better collection efficiency, so Hub Seng performed better in managing its credit sale. The inventory turnover ratio measures how efficiently a company sells its inventory. In 2035, Hub Seng achieved 11.3 times compared to Apollo 10.27 times. This suggests that Hub Seng sold and replenished its inventory more efficiently, reducing storage costs and improving operation. The fixed asset turnover ratio shows how effectively a company uses its fixed asset to generate sales. Hub Seng recorded 4.43 times, while Apollo recorded 3.57 times in 2025. This indicates that Hub Seng utilized its production facilities and equipment more efficiently to generate revenue. Next is the total asset turnover ratio, which measures how efficiently a company uses all of its assets to generate sales. Hub Seng recorded 1.59 times compared to Apollo's 1.13 times. This shows that Hub Seng made better use of its overall assets throughout the year. Overall, Hub Seng outperformed Apollo in all 5 activities ratio. It collected receivable faster, managed inventory more efficiently, and utilized both fixed and total assets more effectively. These results indicate stronger operational efficiency and better resource management. In conclusion, based on the activity ratio analysis from 2021 to 2025, Hub Seng Industri Berhad demonstrated better overall performance than Apollo Food Holdings Berhad. Therefore, Hub Seng can be considered the more efficient company in terms of managing its operation and asset. Thank you. That's all from me.
I will present about profitability ratio. Let's start at the very top of the income statement with the gross profit margin. Hub Seng has shown incredibly strength here. Their margin climbed from 27.61% in 2021 up to 29.77% by 2025. Now they see a slightly peak at over 31% in 2024 before settling into that 29.77% mark, but their overall grip on production costs remain rock solid. Meanwhile, Apollo has a great comeback story. They managed to push their gross margin up from 23.43% to 27.15% over the same period, proving they've gotten much better at pricing and cost control. However, even with Apollo's impressive climb, Hub Seng held the crown every single year, proving to be the more inherently efficient manufacturer. But look at Apollo. Apollo's operating margin went on a wild ride, exploding to a massive height of 25.27% in 2024. This points to an incredibly strong year, likely driven by a massive temporary reduction in operating costs or a huge operational surge. By 2025, Apollo fell back down to 16.94%, leaving both companies neck and neck at the finish lines. Let us see the operating ratio. To understand why those lines move the way they do, we look at the operating ratio, which measures operational expenses relative to the sales incomes. Lower and steadier is what we like to see here. Hap Seng was the poster child for consistency, looking their ratio down tightly between 0.13 and 0.15 over the whole 5 year. They clearly know exactly how to manage the operational overhead relative to the incoming revenue. Apollo, on the other hand, saw its let us see net profit margin. Hap Seng kept its steady and growing theme alive, moving comfortably from 0.09 in 2021 to 0.13 in 2025, with a sweet spot of 0.15 in 2024. Apollo net profit margin, quite frankly, was all over the map. They started at a strong 0.16, cratered down to a painful 0.05 the very next year. Rocketed up to a staggering 0.21 in 2024, and then fell back to 0.13 in 2025, while Apollo managed to hit a higher peak. If you are looking for stability and predictable earning, Hap Seng track record is the clear favorite. Next is return on equity. This is where Hap Seng absolutely runs away with the competition. Over these 5 years, Hap Seng delivered a powerhouse performance, keeping its return on equity between a strong 18.48% and astronomical 35.17%. Apollo deserves a credit for turning things around. They dragged the return on equity up from a low of 4.140% in 2022 to a very respectable 16.96% in 2025. But even Apollo's best effort couldn't catch Hap Seng when it's come to making every dollar of investor money work hard. Hap Seng has been undisputed champion. Last but not least, return on asset. Return on asset measure how profitably a company used its asset. Hap Seng beat Apollo in return on asset each year, ranging from 12.25% to 22.95%. Apollo return on asset improved from 4.09% in 2022 to 15.16% in 2025. Despite this, Hap Seng was better at leveraging its assets to generate earnings during this period.
Now, I will present the leverage ratio, starting with the debt ratio. The debt ratio measures the proportion of a company's assets that are financed by liabilities. A lower debt ratio generally indicates lower financial risk. Based on our analysis, Hap Seng maintained a stable debt ratio of around 32% to 35% from 2021 until 2025. This means approximately one-third of its assets were financed through liabilities. On the other hand, Apollo recorded a much lower debt ratio, increasing slightly from 7.69% in 2021 to 13.92% in 2025. This shows that Apollo relied more on shareholders' equity rather than debt ratio financing. Therefore, Apollo has a more conservative capital structure and lower financial risk compared to Hap Seng. Next is the debt to equity ratio. This ratio compares to total liabilities with shareholders' equity. It shows how much debt a company uses to finance its business. Hap Seng maintained a debt to equity ratio between 0.47 and 0.53 times, indicating a moderate use of liabilities. Meanwhile, Apollo maintained a much lower ratio, increasing slightly from 0.083 times in 2021 to 0.162 times in 2025. This indicates that Apollo depends mainly on shareholders' equity for financings, while Hap Seng uses a balanced combination of debts and equity. Overall, both companies have a healthy leverage position, but Apollo has a stronger and more conservative financial structure. Next is the debt to equity ratio. This ratio compares to Lastly is the time interest earned or TIE ratio. This ratio measures a company's ability to pay interest expenses using its operating profit. In this study, both Apollo and Hub Seng had no interest-bearing debt, meaning they did not have any interest expenses. As a result, both companies have an excellent ability to meet financial obligations and face very low financial risk. This also reflects that both companies are financially stable. Next, I will present the comparative analysis, beginning with the liquidity ratios. Apollo showed stronger liquidity performance throughout the 5-year period. Its current ratio and quick ratio were significantly higher than Hub Seng's, indicating that Apollo had more than enough current assets to pay its short-term liabilities. Apollo also recorded much higher net working capital, showing that strong cash reserve and liquid assets. Meanwhile, Hub Seng maintained a current ratio of around 2 times, which is considered healthy and efficient. Although Apollo had a stronger liquidity, Hub Seng managed current assets more efficiently without holding excessive idle cash flow. For accounts receivable turnover, Hub Seng also achieved a higher accounts receivable turnover throughout the study period. A higher turnover indicates better credit management and faster collection of receivable compared to Apollo Foods Holdings Sdn Bhd. For inventory turnover, Hub Seng again performed better than Apollo. Its higher inventory turnover shows that products were sold and replaced more quickly, reducing storage costs and the risk of obsolete inventory. For fixed asset turnover, Hub Seng also recorded a higher fixed asset turnover ratio. This means Hub Seng generated more sales from every ringgit invested in machinery and equipment. It's showing better utilization of fixed asset compared to Apollo Foods Holdings Berhad. Lastly, for total asset turnover, Hub Seng achieved a higher total asset turnover ratio. This indicates that the company used its total assets more efficiently to generate sales of revenue. Overall, Hub Seng outperformed Apollo in all activity ratios, demonstrating stronger operational efficiency and better resource management.
Now looks at the profitability ratio. Both companies improved their profitability over 5 years. However, Hub Seng generally recorded stronger gross profit margin, return on equity and return on asset. Although Apollo achieved excellent performance in certain years, especially in 2024, its profitability was less constant. Hub Seng maintained more stable earnings and generate better returns for both shareholders and assets. Therefore, Hub Seng can be considered to be profitable company overall. Finally, for leverage ratio, Apollo recorded lower debt ratio and debt to equity ratio than Hub Seng. They indicate that Apollo relied more on equity financing and has lower financial risk. However, both companies has no significant interest-bearing debt, meaning they had a very strong financial stability and very low of the default. Overall, Apollo adopted a more conservative financing strategy, while Hub Seng maintained a balanced use of liabilities. Finally, for leverage ratio, Apollo recorded lower debt ratio and debt to equity ratio than Hub Seng. They indicate that Apollo relied more on equity financing and has lower financial risk. However, both companies has no significant interest-bearing debt, meaning they had a very strong financial stability and very low of the default. Overall, Apollo adopted a more conservative financing strategy, while Hub Seng maintained a balanced use of liabilities.